Review of Corporate Financial Restructuring. Professor Ian Giddy, New York University. Corporate Financial Restructuring. Why restructure? Proactive. Example: sealed air. Defensive. Example: low in 1996. Distress. Example: low in 1999. Management acts to preserve or enhance shareholder value. Management acts to protect company, stakeholders and management from change in control. Lenders and shareholders lose, but try to work out best way to minimize loss. Corporate financial restructuring. Corporate restructuring, business and financial. Structured financing techniques. Proactive restructuring. Distress-induced restructuring. Mergers, divestitures and LBOs. A simple framework. A company is an excess of contracts with shareholders, creditors, managers, employees, suppliers, etc. Restructuring is the process by which these contracts are changed, to increase the value of all claims. Applications. Restructuring creditor claims, Conseco. Restructuring shareholder claims, AT&T. Restructuring employee claims, UAL. TDI nexus of contracts franchisors senior lenders. Subordinated lenders. Salespeople. TDI. Management. Shareholders. Examples: SAP, upgrading shareholder control rights. Sealed air, exploiting free cash flow. Marvel, post-bankruptcy negotiations. Westpac, structured finance. Novartis, merged and divested. Alphatech, rescuing residual value. Novartis, financial restructuring. Fixed the cash and working capital. Fixed the capital structure. Assets. Liabilities. Cash. Debt. Equity. Fixed. Assets. Divested. Non-core. Business. Restructuring checklist. Figure out what the business is worth now. Use valuation model, present value of free cash flows. Fix the business mix, divestitures. Value assets to be sold. Fix the business, strategic partner or merger. Value the merged firm with synergies. Fix the financing, improve DE structure. Revalue firm under different leverage assumptions, lowest WACC. Fix the kind of equity. What can be done to make the equity more valuable to investors? Fix the kind of debt or hybrid financing. What mix of debt is best suited to this business? Fix management or control. Value the changes new control would produce. Valuation is a key to unlock value. Value with and without restructuring. Consider means and obstacles. Who gets what? Minimum is liquidation value. Valuation. Going concern. After restructuring. Liquidation. Getting the financing right. Step 1. The proportion of equity and debt. Achieve lowest weighted average cost of capital. May also affect the business side. Debt. Equity. Getting the financing right. Step 2. The kind of equity and debt. Short term, long term. Baht, dollar, yen. Debt. Bonds, asset-backed. Convertibles, hybrids. Equity. Debt/equity swaps. Private, public. Strategic partner. Domestic, ADRs. Ownership and control. Capital structure, optimal runway. Nestle. Low earn. Value of a firm. Optimal debt ratio. Debt ratio. Cost of capital and leverage method. Equity. Debt. estimated beta with current leverage. From regression, leverage, EBITDA, and interest cost. Unlevered bet AA with no leverage. BU equals BL/1 plus T/E1T. Interest coverage. EBITDA/interest. Levered bet AA with different leverage. BL equals BU1 plus T/E1T. Rating. Other factors too. Cost of equity with different leverage. ER equals RF plus PLR/MRF. Cost of debt with different leverage. Rate equals RF plus spread plus ratings and spreads. Interest coverage ratios, spreads and ratings, small firms. Note that smaller firms need much higher interest coverage ratios to get the same ratings as large firms. Optimal debt ratio for a private company. Example: the optimal debt ratio for the private firm is 30%. The firm value is maximized at that point. This is, however, based upon a cost of equity estimated from a market beta, which measures only the non-diversifiable risk. To the extent that private business owners view default risk more seriously than stockholders in a publicly traded firm, they will probably be more cautious about moving to the optimal. We can extend the argument to closely held publicly traded firms. We would expect these firms to have lower debt ratios than publicly traded firms with diverse stock holdings. Damodran spreadsheets. http://pages.stern.nyu.edu/adamoda/new_home_page/spread.htm. TDI Financial History. Restructuring debt and equity at TDI, A and B. Evaluate the financial restructuring taking place at TDI. Effect of the LBO on capital structure. How did LBO lenders protect their interests? Alternative restructuring plans. Post-December 89 operational, portfolio and financial restructuring proposals. 1990-93 restructuring, before and after comparison. Restructuring debt and equity at TDI, C. Consider the choices facing TDI in 1994. Evaluate the alternatives available to take best advantage of TDI's free cash flow. Leveraged buyout. Leveraged ESOP. Leveraged recapitalization. Or, invest cash or debt in growth opportunities. Or, do nothing to retain flexibility. Restructuring debt and equity at TDI, D. Evaluate the possible means for cashing out shareholder value in a private company such as TDI in 1996. Leveraged recap. IPO. Sale to financial buyer. Sale to strategic buyer. Which when? Leveraged recapitalization. Strategy where a company takes on significant additional debt with the purpose of paying a large dividend, or repurchasing shares. Result is a far more leveraged company, usually in excess of the optimal debt capacity. After the large dividend has been paid, the market value of the shares will drop. Leveraged recapitalizations. Motivations. Defensive. Proactive. Ownership transition/liquidity. Which produces what value? Exchange offers. Give one or more classes of claim holders the option to trade their holdings for a different class of securities of the firm. Typical examples are allowing common shareholders to exchange their shares for bonds or preferred stock. Or vice versa. Motivations. Exchange offers effect depends on leverage increasing or decreasing. Implied increases or decreases in future operating cash flows. Implied undervaluation or overvaluation of common stock. Increase or decrease in management share ownership. Increase or decrease in management control over cash usage. Positive or negative signaling effects. Asset-backed securities. Ford Credit Owner Trust 1999A. Credit Enhancement Guarantee Method. Finance Company.s. Customers. Rating Agency. Hire Purchase Agreement. Top Rating. Servicing Agreement. Finance Company Limited. Seller. Proceeds. FSL 1997A. Special Purpose Company. Proceeds. Investors. Sale of assets. Asset-backed securities. Trustee. Financial guarantee. Provider. If required. Trust. Agreement. Guarantee. Agreement. Credit enhancement, an alternative approach. Rating agency. Top rating. Senior. Lower rating. Finance Company Limited. Seller. Proceeds. FSL 1997A. Special Purpose Company. Subordinated. Sale of assets. No rating. More subordinated. Financial guarantee. Provider. If required. Guarantee. Agreement. The alternative, synthetic ABS. DB, originator. Reference. Pool of loans. Stay on. Balance sheet. Credit swap. Agreement. Special. Purpose. Vehicle. Issues. Top quality. Asset-backed. Investments. Certificates. Corporate financial restructuring. Why restructure? Proactive. Example. Sealed air. Defensive. Example. Low in 1996. Distress. Example. Low in 1999. Management acts to preserve or enhance shareholder value. Management acts to protect company, stakeholders and management from change in control. Lenders and shareholders lose, but try to work out best way to minimize loss. Match the solution to the problem. Trouble. The financing is bad. Business mix is bad. The company is bad. Reason. Raise equity, or do debt/equity swap, or change debt mix. Sell some businesses or assets to pay down debt. Change control or management through M&A. Remedy. Reorganization processes. Out-of-court negotiated settlement. Firm continues. Exchange, equity for debt. Extension, pay later. Composition, creditors agree to take less. Firm ceases to exist, assignee liquidates assets and distributes proceeds on a pro-rate basis. Merger into another firm, which assumes or pays off debt. Continues as subsidiary. Absorbed into other operations. Formal legal proceedings. Firm continues. CH11, court supervises composition or modification of claims. Firm ceases to exist. Statutory assignment. Assignee liquidates assets under formal legal procedures. CH7 liquidation. Bankruptcy court supervises liquidation. When default threatens, value the company. Zombie Incorporated valuation. Valuation in distress restructuring. Liquidation value. Acquisition price. Enterprise value. Enterprise valuation in distress restructuring. Multiples. FCFF discounted at WACC. APV. Capital cash flows. Option value. Marvel secured and senior get fully repaid under plan choices. Banks. Secured and senior. Get fully repaid under plan. Icon et al. Choices. Accept Perelman's plan. Sell the debt at $0.14 $0.17. Reject plan and propose own. Perelman. Controls Marvel equity. NPV is negative. Option value may be positive. Marvel's option value, November 96. Break-even stock price equals debt value / no of collateral shares. Debt value equals MKT price face value, x6. Collateral shares equals 77.3 meters. Equals $709.5 77.3. Equals $9.18. Option value. When Marvel's stock price is below $9.18, Perelman's investment in the holding companies is worthless on a liquidation basis, but still has option value. Break-even stock price. Marvel Ent. Price. $4.63. $9.18. November 96 stock price. Mergers and acquisitions. Gains from merger. Synergies. Control. Top line. Bottom line. Financial. Restructuring. Business. Restructuring. M&A. AOL Time Warner Possible motivations economies of scale and scope. Diversification. Access to new technology. Regulatory arbitrage. Hubris. Possible problems. Overestimating synergy. Slow pace of integration. Poor strategy. Payment in stock. Overpaying. Poor post-merger communication. Conflicting corporate cultures. Weak core business. Large size of target company. Inadequate due diligence. Poor assessment of technology. AMP/Allied Signal /Tyco. What defenses did AMP employ? Who won? Who lost? Comparables value indicator earnings cash flow revenues book average. Industry. Firms. Deals. Target. Company. Numbers or projections. Estimated. Value of. Target. What's it worth? Opticast earning with synergy. Conrail, obstacles to an unfriendly takeover. Pennsylvania. Fair value statute, bids greater than 20% all get same price. Bidders' voting rights maxed at 20% unless management approves. Constituency statute, protect unions. Conrail. Breakup fee to CSX. CSX has lockup option to buy 16 meters new shares. Poison pill, suspended for CSX. Shareholders get new shares at half price if outsider buys 10%. 6-month no-talk clause. Takeover defenses poison pills shark repellents golden parachutes. Preferred flip over stock. Flip over rights. Flip in rights. Poison put bonds. Shark repellents. Limitations on board changes. Limitations on shareholder actions. Supermajority rules. Anti-green mail limits on share repurchases. Fair price provisions. Supervoting stock exchange offers. Reincorporation. Golden parachutes, post-takeover bid responses. Just say no. Litigation. White Knight. Green mail. ESOP. Pac-Man. Restructuring, including leveraged recapitalization. Share buybacks. Using cash for acquisitions. Divestitures. Going private. Liquidation. Breaking up. Why, the business may be worth more outside the company than within. How, sell to another company, or to the public, or give it to existing shareholders. Tax aspects. As a rule, if you get paid in cash, you realize a taxable gain, not otherwise. Effect on shareholders. The bigger the part sold off, the greater the percentage gain. Tax-free breakups. Spin-offs. Pro rata distribution by a company of all its shares in a subsidiary to all its own shareholders. Split-offs. Some parent company shareholders receive the subsidiary's shares in return for their shares in the parent. Split-ups. All of the parent company's subsidiaries are spun off and the parent company ceases to exist. Tracking stock. Special stock issued as dividend, pays a dividend based on the performance of a wholly owned division. Taxable breakups. Divestitures. The sale of a division of the company to a third party. Equity carve-outs. Some of a subsidiary's shares are offered for sale to the general public. Split-off IPOs. A private company offers a part of the company to the public. Bust-ups. Voluntary liquidation of all of the company's business. Breakup computation. Source: breakup.xls. LBO, a temporary capital structure. Stage 1, pre-LBO. Stage 2, LBO financing. Stage 3, LBO refinancing. Stage 4, debt paydown. Cost of capital debt ratio. Cost of the deal. LBO-capacity.xls. Borrowing capacity. From table. LBO-capacity.xls. Cost of debt. LBO-capacity.xls. Capital structure. LBO-capacity.xls. LBO financing NewCo senior debt $457 cost of purchasing the business. What securities? What returns? What investors? Mezzanine. Equity $25. How much equity for management? How much for the VCs? Case. Does it work? How much equity for management? How much for the VCs? Management. Bankers. VC investors. How the Asian bet was lost. The three excesses. Too much debt. Too much labor. Too much capacity. How the Asian bet was lost. Vulnerable economies, newly liberalized, succumb to currency crises. Vulnerable corporate financial structures. Companies were unable to service even domestic debt, never mind foreign currency debt. Many Asian companies resisted reform even after the crisis, and remain misfinanced. What's needed? Corporations must implement the key principles of corporate finance, estimate realistic cost of capital and discard investments below the WACC. Shareholders must exercise ownership rights. Banks must break the link between loan origination and collection. Governments have to leave insolvent borrowers to their fate. Regulators should get tough on loan classification standards. What do debt equity swaps do? Overleverage creates financial distress. Actual or potential default. Lenders take equity in lieu of repayment. Lenders hold equity passively. Lenders replace management. Lenders sell equity. Existing management buys time. Change of control. Means restructuring. Financial engineering. Bottom line rationalization. Divestitures and outsourcing. New equity for Astra. What investors? What returns should they expect? Portfolio investors. Financial investors. Corporate investors. What returns should they expect? Equals risk-free rate. Plus corporate risk. Plus financial risk, leverage/debt mismatch. Plus agency cost premium. Plus country risk. What restructuring?